right, let's get started, Dan. Welcome to our June podcast. And we're basically here to talk about what is on the mind of investors right now. My name is Brett Heine from Cornerstone Private Wealth, and I'm in the studio with my partner, Dan Lesneski.
Great to be here, Brett.
Thank you for coming. So let's discuss the format a bit. Dan and I have been doing monthly webinars for I think it's been about 4 years, Dan?
Yeah.
And the format has been received very well by our clients. What we basically have done for the last 4 years is we talk in detail about the questions that we've been getting from clients, right? And discuss the questions. And we get those questions through our daily client conversations. And we also have been encouraging clients to send in emails and let us know what we want to cover in the next webinar. So we're going to use the same format here. So this podcast is really, we're looking at it, it's really meant for our clients to kind of address some of their most frequently asked questions. And we suspect it might have a broader audience, right? But we're not trying to replace Joe Rogan by any means. We're here to cover what we think our clients are concerned about. So Dan and I had a talk yesterday about some of the topics we've been getting. Why don't you start off with it and tee up a couple of the topics?
Well, certainly, I don't think May gave us any shortage of interesting things to talk about. So we're going to cover the volatility in the stock and bond market that we all kind of lived through this past month, the big, beautiful bill that's currently working its way through the Congress, the Moody's downgrade, some interesting charts, you know how Brett loves charts, and just earnings season and the state of the consumer.
Great. Awesome. So let's jump in first on the market volatility in the stock market, because I could tell you what, it's been crazy. You could see I have more wrinkles. Dan still looks young, but I have some, if you compare January to now, I have a lot more wrinkles. But, if you were on Mars somewhere out of the country for the last 5 months and you looked at the S&P returns through the end of May, and you looked at it and said, wow, the S&P 500 is up 0.7%, so just less than 1% for the year, you'd probably think it was pretty calm, right? And it's crazy, but it wasn't. As we know, we had an upturn followed by a downturn, and we'll talk about it. But May, thankfully, we finished it. It was a great month. We finished the S&P 500 had its best month. Same with the NASDAQ in about 18 months. The S&P 500 was up about 6%, about 6.1. NASDAQ was up about 10%. I think the Dow was somewhere around 3%. And it was big technology that was really the standout in May. You had NVIDIA up something like 24% after the blockbuster earnings. Also Tesla up like 23%. And I think that was mostly due to maybe Elon Musk getting back on board and moving a little bit away from Washington. Interestingly, gold was down. It was notable. Was down for the first time in about 5 months, only down about 0.1%. And bonds had a little bit of a rough month, and we'll cover that. But May was its best May since 1990. We'll show a chart on that on the May returns, and I want to get your comment on it because May is an interesting month. I've had a couple clients last month ask, should we sell in May and go away? That's an old adage, and that goes all the way back to the Stock Traders Almanac from many, many years ago, where they did a study, and it showed if you sold May 1st and got out of the market until October 31st and went into bonds and then got back in for 6 months, you would have had a positive rate of return. So I'll throw that back at you. Do you think those things? I don't think they're really valid anymore, and we've had 2 good Mays, but what do you think about that strategy?
No, I think, you can look at a lot of these strategies kind of in a vacuum and say, hey, if I get the timing right, it looks great going back. But as you and I both know, working with clients every day, that the hardest thing is convincing people to stay invested, right? And there's always a reason. It might feel good to get out in May, enjoy the summer, focus on family and the beach. But then, if October doesn't look so rosy, all of a sudden people want to stay on the sidelines, or maybe the market moved and there's some, pressure to get back in a little bit earlier or more aggressively than they otherwise would have. So, staying invested, I think the saying that we're fond of is time in the market is more valuable than timing the market.
Well said. It's interesting. So that brings us to our first chart. Dan and I, we fight about how many charts. I wanted to go with about 50 charts, and he wanted to go at 2. So we met somewhere. We met somewhere in the middle. But I think an interesting chart we'll show you is the S&P 500, and you can see this chart of the S&P 500. We show this a lot to clients. It goes all the way back to to 1997. So that would represent about 28 years. And what you see is the market zigzags, right? This chart started in 1997 when the S&P 500 was about 800. I think it closed Friday at 5190, something like, or 5910, something like that. So it's been mostly up, but you have these big corrections.
Yep.
And if you zoom in this year, we'll see if my computer allows me to zoom in. I think it does. What you see this year is a big V-shape move, and it's been amazing. If you look back, I was looking at my calendar the other day, Dan, it said we're in a 22nd week of the month. But if you look at it, it's been really like a 7-week journey. So the beginning of the year, we started out, the market rocketed up the first 7 weeks. It was actually up about 5%, about 4.7, made an all-time high. And then we spent 7 weeks on a 20% downtick.
Yep.
Right. And then we've completely round tripped and we have a total V-shaped recovery. And I think that speaks for it. And all kind of bottomed right after the Liberation Day on April 2nd. And, it's come back. And so I think that speaks to what you said about not timing the market.
Yep. And I would say one of the big catalysts in May, obviously, for the reversal has been, this temporary truce that we've had in the tariff war.
Right.
We really started to see things ramp up. Initially it was with the announcement of the kind of framework for the UK and the US, but then the real turning point was when the US and China had their meeting in Switzerland. We got a 90-day rollback on those tariffs where the US dropped tariffs from 145% down to 30, China from 125 down to 10. It seems like over the past handful of days, that framework or those talks have stalled a little bit. So we will definitely be looking at that rather intently to see how that develops. But that was really the catalyst for May in my estimation.
It's a good point. Yeah, it's been really this year, you could think about it as, they say the 3 most important words in real estate are location, location, location. This year, it's probably the questions have been really tariffs, tariffs, and tariffs. But back to the chart, you can see, the month of May, we mentioned it was a very strong month. We mentioned 6% for the S&P, and you could see this going back. It's the best May since 1990. So that was encouraging. Another story to think about with the tariffs. It's been, you talk about, the tariff stuff. Just the other day, we saw I think it was Peter Navarro on TV, and I had to cringe a little bit because what's happened this year, it's been like, I think what Trump has done is he put Treasury Secretary Bessent in the lead, and that's been a kind of a calming effect on the market in regards to tariffs because he has good Wall Street cred, and he seems to be level-headed. I saw Navarro. He's the Commerce Secretary, come back on CNBC the other day, and I had to check the market because what was happening in April during the tariff dilemma, every time Peter Navarro came on the market, it seemed like the S&P took a downturn. So, and I think it's just maybe his approach, right?
Absolutely. I mean, he's a little bit more of a bomb thrower, I think, to put it mildly, than Scott Bessent is. And yeah, the market can deal with a lot and it can weather a lot of uncertainty and a lot of changes in terms of policy. But when the news becomes, a little bit too bombastic and it seems like there's these constant reversals in policy, that uncertainty does start to creep into investor behavior, and you start to see panic selling or even shorting in the case of some of the institutional investors. So, a steady hand at this stage of the game is probably welcomed.
Yeah, and investors, it's still on the mind of investors, and really, we've been talking to clients. There's really 2 paths. I guess there's multiple paths, but 2 paths that the President Trump could be going. And the first would be perhaps he's using the tariffs to negotiate maybe lower tariffs around the world if it is a negotiating technique. And that might increase trade, right? So that could be a win. The second would be if we're just using tariffs permanently, and we've tried that many times in the past. We'll show a chart on that. It hasn't worked effectively up until this point, and you end up diverting trade in other directions. So this is a great chart going back to over 100 years, because it goes back to 1900, and just looking at the history of tariffs. And what you found is during the Great Depression, you had the Smoot-Hawley bill, and you had a big uptick in tariffs, and that coincided with the deepening of the Great Depression. So after that, we had a long series of no tariffs, and you see these these lines here, we don't really know what the long-term tariffs are going to be, but you could see it kind of goes off the charts.
Yeah, and I think, as with most things that we're seeing in kind of society and our politics in particular, right? There's tends to be pretty severe reactions and almost overreactions on both sides of the political aisle. So, you're going through the period of the '90s and the early 2000s, and it's really a more global type of economy, more free traders. You've got NAFTA, things like that, where you know a large portion of the U.S. started to really feel like they were being left behind as the world continued to advance. And I think the best reading of the tariff policy is, hey, we're trying to make some corrections for that period in American history and really set the middle class up for success. The downside of this is that if they overcorrect here and if they miss the mark, as to Brett's point, it can be a real drag on the economy, and it can also end up having the opposite effect of what they're intending, which is, suppressing employment, suppressing opportunity and investment. So they're on a really delicate balancing act right now. Regardless of who you voted for in the election, we got to hope that they end up on the right side of this and really provide a positive result. Just one other point I would bring up on the tariff front. We've had the conversations with the UK and China. The thought process is that we're relatively close with South Korea, Japan, and India on getting some resolution. But the big conversation over the next couple of weeks will probably focus primarily around Europe.
Right.
And it's not just the tariff rates that's going to be a sticking point there, but also some of these non-tariff barriers, the value-added tax, and specifically our ability as U.S. providers to send our food products into the EU. So it'll be interesting to see how that develops. I think that could move the market pretty substantively in one direction or another.
Definitely something to look at. Definitely something to look at. So let's move on to earnings. I was surprised to see that S&P earnings came out. We're done first quarter earnings season, and it was a great quarter. If you look at it through FactSet as of last night, and pretty much we've had like 98% of S&P companies report, and it looks like coming in about 79% of companies beat earnings estimates, and overall the S&P earnings were up about 12.9%, which is really almost double the 7% that they've been expecting, and this is really the second quarter in a row that we've had double-digit earnings, which is, I think that's a real sign of resilience. The other thing that we're looking at for clients is you have to look at the consumer. And at this point, the consumer seems to be pretty resilient. You can look at that we saw really some strong earnings results from even consumer-related companies like retail and apparel companies. I know TJ Maxx, Ralph Lauren, Canada Goose. They make those super expensive coats. They had a great quarter, you would think. So we have to look at the consumer because the consumers are still 70% of the economy. So what we don't know is how much of that is was there a pull forward? Were consumers doing what we think companies were doing? Were they maybe buying stuff in anticipation of the tariffs? So we don't. That's still an open debate.
Yeah, I think that's a great point, and time will tell on that front. Certainly, it had to have impacted consumer behavior to some degree, right? You can see that especially with auto purchases. People have been kind of eager to get out ahead of that. But yeah, summertime, we're going to start to really see even the initial wave of tariff announcements, how that impacted consumer behavior as we start to get into the summertime here. So definitely something to keep an eye on. And I don't think people have focused enough on the fact, to your point, that we've had such strong earnings growth now 2 quarters in a row. Also, kind of under the radar piece of news is that they did an upward revision on GDP for last quarter as well. So maybe we might avoid that recession talk that we were really it was taking top of mind.
Yeah, and the other thing, but when you get back to the consumer, it's been you've heard this over the first quarter too, the relationship between, we'll call it more the soft data versus the hard data. And you're seeing the soft data, things like, and we'll show a chart on consumer confidence, that has fallen off a great deal. Or if you ask people to predict their expectation of inflation, it's pretty negative. But then the harder data, like some of this economic data that we're talking about, has been pretty strong. Again, maybe part of that is the pull forward. So let's let's show you a couple other charts, and you can see, interesting. We mentioned first quarter earnings. Again, on the earnings call in the first quarter, pretty much every company is mentioning tariffs on the call. We've been tracking that, and we also track it even compared to AI. Interestingly, in the first quarter, AI, just mentioning AI on the calls have dropped off a bit. I guess tariffs have kind of taken some of some of the limelight there. Here's a chart I can't help myself but to show every month. This is something that we follow a little bit as a contrary indicator. But yesterday, on May 30th, the University of Michigan Consumer Sentiment Report came out again. You can see we have the data here going back from 1971. This is kind of a contrary indicator. Interestingly, it came out as the second worst reading ever in history. The first worst reading was a couple years ago in June of 2022. But so it was a real negative reading. But you see at these troughs in the past, that blue number in the chart correlates with the future return of the S&P 500. So again, it's interesting that the consumer is feeling it in some ways, but they're still shopping. So I don't know if it's just investor behavior or what.
The American consumer is just so resilient, and there's one thing we can batten down the hatches, so to speak, when things get a little bumpy. But yeah, you're absolutely right. I mean, we have not seen the slowdown we expected in consumer purchases yet, which you would think would track in line with how uncertain people feel. But they're out there, they're spending. We're about to go into a time of the year where there's more time with family, more activities, vacations, things like that. So, I expect consumer spending to continue to be, on the stronger side, despite all the challenges. But I'll tell you what, it doesn't make that grocery bill any easier to
Right.
to digest every time you go.
Yeah.
Yeah.
And it's split between party lines. This was an interesting chart. We've looked at many times, and it's Pew Research via J.P. Morgan in their Guide to the Market Monthly, and they just a long term going back to the Bush administration. What you see here in the left line is, and what we're looking at here is the percentage of either Republicans or Democrats that view the economic conditions as excellent or good. And what you see during the Bush administration, Republicans, the red line, they were pretty high, and Democrats were pretty low. It flipped over in the Obama administration. Democrats saw the economy as pretty good. Republicans, not so much. It really flipped over in a big way in the first Trump administration, where Republicans, over 80% at one point, saw the economy as excellent and good. And, of course, a reverse during the Biden administration. And here we are again, a big gap just came out that this survey this month, where about 36% of Republicans see the economy as excellent to good, and only 11% of Democrats. You think that'll ever change?
It seems like, as with most things in American life, it's pretty tribal.
Right.
What I think is interesting about that, though, is that even on the Republican side, the 36% is a weaker number, I think, than historically we're used to seeing for Trump.
Right.
The Democratic number, I think, is more of kind of a protest vote, right?
Right.
But I'll be curious to see. I mean, if he can get some real resolution on the tariff front, I think he's setting himself up for success moving forward. But it's a big if. It is a big if. And, maybe one day we'll all agree if the economy is good or bad, but hasn't happened in my lifetime.
Yeah, and that's a good point, because if you look back at Trump, one administration, you could see it's clearly, for the most part, it was above 50%
And the tariff playbook is somewhat different, but there are a lot of parallels between, the current posturing and his first administration.
Right. And using some of the University of Michigan study itself, right? This was this up until present day. This looks at the University of Michigan study, and we're looking at even just the guesstimate, because what they do in that study is they drill down, they classify, they'll look at Democrats and Republicans, and also ask them where do they think inflation is going to go, and they can hardly agree with that. Now we have Democrats over the next 12 months predicting inflation to go to 8%. While Republicans are expecting inflation to go to 0.4%. So that's a pretty interesting chart there.
Yeah, and I think the reality will probably be somewhere in the middle. I certainly would root for that Republican sentiment there with 0.8% inflation. But yeah, it'll be very interesting to see how this works out. I mean, the tariffs, I don't think there's enough focus on how inflationary they potentially could be.
Right.
And again, we're just going to have to see where this plays out. It's, in some ways, it's like Groundhog Day in the stock market right now with tariffs. It's, cycle of increases, pauses, decreases, et
Absolutely.
cetera.
Another interesting thing came up. We got this from Fundstrat slide where they pulled Redfin data. This just came out recently where you have to look at housing. We talked about the consumer being 70% of the economy. Housing is a big part of inflation. It's a big part of the economy. So we look at it closely. And what happened recently, you could see that the number of homes on the market, it's something like 1.9 million. So there's more sellers out there than buyers right now. By about by a big margin. You can see a widening gap. So we'll have to take a look and see if that correlates with lower prices. It really hasn't. But this speaks to the importance of housing. If you look at the CPI, a measure of inflation, in April, you could see housing, auto, and is really been, but it's about 50%, 56% of the inflation numbers. And even going back to 2019. Housing, auto, it's 76% of the change in inflation. So we have to, if housing does come back a bit, that could affect the consumer.
And we really want to keep a keen eyesight on also the rental prices and the rental market. I mean, we think about housing prices in the aggregate for new home purchases, but the rental market as well is a huge component of that housing inflation cost. And, we want to see that trend continue to kind of, moderate, which it's been very stubborn.
Right. Yeah. I wonder when you drive, we're close to Philadelphia, and you drive over and see all those new rental apartments near you over in Northern Liberties. I wonder who the heck are renting these things, but there must be a lot more renters.
Oh my gosh, it's nonstop. I mean, and they won't, the building continues to go and the demand is there. So I just don't see that letting up in the near term.
So I'm going to turn this one over to you, a touchy subject. What do you think? We have this big, beautiful bill passed through the House, right? So I guess it's moved on to the Senate. They'll have to, get approval in the Senate and then just kind of reconcile that thing in both chambers. But the best case, I guess, on timing might be like early August. What do you think there?
Yeah, so the bill does a lot. Right. So, again, I think it's one of those, the Republican Congress has been very successful at crafting a bill that basically no one is happy with. Right. And that you can read that one of two ways. You can read that as that's a good sign of compromise, or maybe they're reaching a bit here. But let's talk about really what that bill is doing. So first and foremost, it's extending the tax cuts for corporations and high earners that we had in the 2017 Tax Cuts and Jobs Act. It is going to significantly impact spending on healthcare and foreign aid. And, for us on the East Coast and some of these higher tax states, the aim is to increase the SALT deduction cap, which, that was a big point of contention, especially in New Jersey. All of these in combination, though, it looks like it's going to be pretty deficit heavy and looks to increase the deficit over the next 10 years to the tune of close to $4 trillion. So while there's some significant cuts, definitely some significant cost incurred on this as well. And I think that sticker shock is one of the things that was been a key driver with the rise in Treasury yields.
Right.
And probably a major contributory factor to the Moody's downgrade also.
Absolutely. Yeah. And you wonder if the SALT, I'm glad you mentioned the SALT thing, because in the bill, currently at 10,000, they put it at 40,000.
Yep.
Okay. So that's going to be tough. Obviously, we're in New Jersey here, New York, Illinois. The senators and Congress people from those states, it's a big issue with their folks, right? But you're going to lose some people, and the Republicans can't lose people. I know they're going to lose Rand Paul on that, but I think they might lose him on anything. But they can't really lose a few people, and that SALT thing might be. You could see that number potentially coming down to get that thing.
And it's going to come down. It's going to come down to the math, right? So I think they have 220 seats. They need 217 to get it over the finish line. And yeah, if they lose 3 or 4 reps on the SALT deductions, it's a real problem. I will say that on the Senate side, to your point, with Rand Paul or Ron Johnson some of the other Republican senators that want to see larger deficit, reduction measures included in the bill. Um, there's not a whole lot of wiggle room here, so
Right.
they're really going to have to work hard to get this thing landed.
Absolutely. Yep. Let's shift gears, talk about something positive. We had in the month of May, we had Warren Buffett's annual meeting,
Yep.
and it was televised. I watched a bunch of it. It was one for 4 or 5 hours on a Saturday, and it's always full with nuggets. But it hit the press a lot. He was, he announced that he would be stepping down. So I want to talk to you a little bit about that. But before you do, look at this chart. I mean, this is just an amazing chart looking back. And all we're doing with this chart is comparing during Warren Buffett's tenure from 1964 to 2024, the return of Berkshire Hathaway compared to the S&P 500. By the way, S&P 500 was no slouch, up 39,000% during that period. But just look at the chart, and the performance kind of speaks for itself. But what were some of your thoughts? I know you watched and read his comments and watched that meeting closely.
He's just such an important figure in the history of investing, and just such a font of wisdom. We were looking through, and I kind of nostalgically flipping through, going through some of his quotes that I thought were particularly relevant for everything that's been going on today. And one of the favorites that came up to me was, I said something to the effect of, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. And to me, looking at things, thinking about the market for technology and AI, and how much these advances in science will prove to be impactful in our lives. And it's really like, you got to kind of set the noise away to the side and really focus on what an opportunity here. And another great one that he had thrown out, that I know you've referenced this in the past, but it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that's one of the, the obstacles to investing that we have to put to the side, is really look at, hey, maybe we missed a short-term run on this, but if it's a really good company with good fundamentals and good long-term value, it still has a place in a portfolio, and it makes sense to put money there. So he's got a quote for everything. There's some funny ones that we didn't get into here, but just a true gem of a person, and really a sage.
And what, 93 years old? Still,
still sharp.
Thinking about a retirement strategy. One that came up too, and I don't know if it was I think it was during a Q&A, but there was a question that I wonder how many CEOs would answer it this way. It was like, why are you not buying back more of the stock? And he said the stock is expensive. So his own stock, is expensive. So that's pretty pragmatic, right? We don't do buybacks if our stock is overpriced. I wonder how many CEOs will say the same thing.
Well, that's his hallmarker, right? He's just a simple, steady, disciplined investor, and he tells you kind of what he thinks at all times.
Let's shift gears again and touch on, should we be worried? We had the Moody's downgrade this month, and they downgraded the U.S. debt just one notch, okay? And they cited the increasing burden of the federal government budget deficit just continues. Both Democrats and Republicans spend. They spend differently, but they spend. But Moody's, on the other hand, was the last of the three credit agencies. Remember, it was the market really took a big hit back in August of 2011.
Yeah.
That was the big one when S&P cut all three rating agencies had U.S. at AAA. And then Fitch cut it, I think that was about 2023. So this is a little bit late. It's the third round. Do you think it's a big issue?
The downgrade in and of itself, I don't think is, but I do think it speaks to the longer term issue that we're faced with as a nation. And that's, with a $36 trillion national debt,
right?
We're quickly running up to the point where the interest on servicing that debt is becoming one of, if not our largest line item.
Right.
And, there hasn't been a whole lot of political will from either party to really address, significant spending cuts, not only on social programs, but also on defense spending, or to raise taxes in a significant way to kind of make up that gap. And it's got to be a combination of both. But hopefully this provides, a kick in the butt, so to speak, for Congress to say, hey, we really need to focus in on this.
Yeah, it's interesting. brought this up with a client, and it was back in 2009. I had a client very concerned when the debt went up to 10 trillion.
Yep.
So we laugh about it now because he just felt like that was a psychologically important number, very smart financial person. And he was very concerned at 10 trillion. Why were you using the terms? It's chump change, billion.
Yeah,
These are trillions. 10 trillion back in 2009. Here we are at 36 trillion.
Yep.
So we'll be sitting here talking about 50 trillion at some point, and we'll just keep kicking the can down the road. So,
and it's, it is becoming an issue, even outside of the, it's obviously of primary concern for U.S. investors, but internationally, I mean, we saw a note out of Hong Kong's regulator where they issued a warning, to their pension funds, right, to be mindful of the amount of U.S. debt that they were taking on, and it's a national security risk for us. So I do hope that at some point it becomes a significant focus, and really you get a bipartisan effort to work to reduce that deficit.
Yes. So what do we do from a stock market standpoint? What we're basically recommending is have a strategy, have an asset allocation. We think you kind of stick to it. I steal another chart from Tom Lee, who does a great job at FundStrat. I'm a member of his. He has a monthly group. They do a series of webinars. But he points out that he calls it a very hated rally. And we had that, you can see in this chart here, we had it back in 2009. And then after COVID, that 2009 was after COVID when it first bottomed out. Remember March of 2020 when COVID came out, there was a terrible correction. It was 23 days. We had a 34% market correction. And then that was also a V-shaped recovery. And it was what he called a hated rally. We had very high consumer confidence levels. Very low consumer confidence levels. People hated the rally, even institutionals. You can see the comments there. Same thing after 2022. That was a bad bond year. We had a rally back to new highs, a hated rally. He's calling this a hated rally, and that's a good contrary indicator because the fact of the matter is you see hedge funds that are shorting the market. And institutional investors are not very confident. You could see that by the $7 trillion in money markets.
What's been really interesting about this too is that those prior hated rallies, you had significant Fed intervention.
Interesting.
And we haven't seen that this time around, right? And Jerome Powell, to his credit, has been relying on market data, right? Everyone would love to see interest rates come down to a degree, but if you have the potential inflationary impacts of tariffs in place, I certainly understand the logic of keeping rates higher to mitigate that to a degree. But you saw really a retail-driven rally this time around, which is also interesting given where consumer sentiment has been, right? We're kind of in this no man's land where, it's not functioning normally. But I do think it's a positive sign that people are still saying, hey, you know what? If there's a good company, again, at good value, maybe I wanted to get in on the AI trade, but things had gotten so over the top, quick 20% downturn. Right. Now, they're not cheap, but they're certainly on sale.
Exactly. And then I'll bring it to the last chart we'll cover is one of the colorful favorites going back. This chart goes back to 2010. So you were talking about 15 years, but we have these going back 100 years. But what you can see is various segments of the stock and bond market. But if you look at it year to date, you see that international is leading the way. Developed international equity year to date up about 17%. But you can see in these charts that it kind of varies. The white line is just a simple asset allocation strategy. And what you see with the simple asset allocation strategy over time is that it's never going to be at the bottom and it's never going to be at the top. But over time, you get a good rate of return. So that's a good chart to level set what you might be thinking from an asset allocation strategy. Because if you look at that return over the last 15 years, that asset allocation mix is around 7%, 7.2% return with a lot less volatility. By the way, it's holding up pretty well this year, up about 3.6%. Bonds are still outperforming stocks because stocks are barely up. So what are your thoughts on that strategy?
I think that speaks to what we've been saying pretty consistently now, especially over the past 4 years on these calls, but much longer than that it's developing a portfolio that makes sense for you, that you can stick with, that has a good mix of various asset classes. Because again, in the short term, any one of these different asset classes can really out or underperform. And it's about staying invested, staying on track, staying with your plan.
Right.
And this is a perfect way to help mitigate that.
Awesome.
So no, I couldn't agree more. I mean, it's one of my favorite charts as well. But I'll tell you what, it's hard to fight the urge in a given year
Absolutely.
to not try and chase the hot dot.
How many times you think this year's different and you can chase the hot dot? So you made me go to another chart because so this will definitely be less short. But and as another reminder is why you can't time it is that just again from Fundstrat and Tom Lee, last couple years you had returns in the S&P 500 up 24%, up 23%. But if you miss just the 10 biggest up days, you're only up 4%. You could see that every year. Basically, if you're not in for the up days, you're just going to give up your returns.
Yep.
And by the way, they don't send you tomorrow's newspaper, and they don't send it to us, so we don't know when the biggest up days are.
Absolutely. No, I think that's good advice. I mean, just staying invested and again, fighting that urge. That's what we're here for. Give us a call when markets are uncertain, which these days seems to be more and more frequently. But that's what we're here. Part of our job is planning, part of it's research, part of it's investing, and a big part of it is also, being a shoulder for our clients in times of uncertainty to help them kind of, make it through those stressful periods of time.
It's great. Yeah, I couldn't agree more. What anything we missed on I'm looking through my notes and I have listed here various conversations and questions I had from clients during the month of May, and I think we've covered, for the most part, the hot items. Any closing comments or anything you feel we missed?
Yeah, I would just say in closing for clients, I expect the summer, in some ways things slow down a bit,
Mhm.
right? But I expect it to be a pretty news heavy summer. Okay, both from a tariff standpoint, from a geopolitical standpoint, and it's just a time to stay vigilant, to stay in contact with us, and just kind of fall back. Let's revisit financial plans. Let's use some of this downtime to go ahead and really just make sure we're still on track there. But do your best to take in the news, but not hyper focus on it.
Great advice. Yeah, and just this week alone, Dan's a certified financial planner on our team, and we've done just yesterday. We had a couple, pretty long calls going over financial plans, looking at it. A 20, 30-year projection, puts a lot of this into perspective. So we're happy to, if we haven't done a financial plan for our clients in the past or recently in the recent past, good time of the year to do that. A lot of times people wait till the end of the year, but the end of the year can be kind of busy. So I think that's great advice. Take advantage of a little bit of the downturn. We had the calls yesterday on a Friday, which is typically in the summer a light day for us. So it'd be a good time to do the data entry stuff.
Absolutely.
Great. Well, thank you all for tuning in. We're excited about our new format. And again, for the clients out there, any questions you'd like us to cover, please send them in.
Thanks,
you very
everyone.
much.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.